Goods and Service Tax. The context. After years of haggling and histrionics, finally on 3rd of August 2016, the upper house of Indian Parliament, the Rajya Sabha, passed the Goods and Service Tax Bill 2014 with certain amendments. The decision was near unanimous, with only the AIADMK staging a walkout. This development was followed by an unanimous support in the lower house of Indian Parliament, the Lok Sabha, within a week's span. That was on 8th of August 2016, to pass the bill, including an amendment to the Constitution 122nd Amendment Bill, which was earlier passed by the Lok Sabha in May 2015. Given the nature of the legislation, as it is going to impact the center-state relationship, especially the financial appropriation in part of the two, the bill needs to be passed by 15 out of the 29 states in the country. The development is important both in prelims and in mains. It also highlights certain auxiliary aspects of the syllabus, such as the center-state relationship, passage of bills in the parliament, constitutional amendments, money bill and finance bill, and the financial appropriation between center and states, including the significance of the Finance Commission. However, on this occasion, we would keep our discussion restricted only within what is goods and service tax, its impact, pros and cons, etc. What is goods and service tax? Goods and Service Tax, or GST, is to be a comprehensive indirect tax on manufacturing, sale and consumption of goods and services across India. It is to subsume all other smaller indirect taxes on consumption, like service tax, etc., levied by the central and state governments in India. It is to be levied and collected at each stage of sale or purchase of goods or services based on the input tax credit method. It is actually a value-added tax levied at all points in the supply chain, with credit allowed for any tax paid on inputs acquired for use in making the supply. It would apply to both goods and services in a comprehensive manner, with exemptions restricted to a minimum. In keeping with the federal structure of India, it is proposed that GST be levied concurrently by the centre as CGST and states as SGST. It is expected that the base and other essential design features would be common between CGST and SGST, and also across SGSTs for the individual states. Both CGST and SGST would be levied on the basis of the destination principle. Thus, exports would be zero-rated and imports would attract the tax in the same manner as domestic goods and services. Interstate supplies within India would attract an integrated GST, which would be an aggregate of CGST and SGST of the destination state. Additionally, alcohol for human consumption has been exempted from the purview of GST. GST will apply to 5 petroleum products at a later date. The GST Council will recommend rates of tax, period of levy of additional tax, principles of supply, special provisions to certain states, etc. The GST Council will consist of Union Finance Minister, Union Minister of State for Revenue, and State Finance Ministers. On the successful passage of GST, the Government of India has come out with a proposed roadmap to roll out, keeping April 2017 as the target date. The entire process has been identified into 3 broad categories, that is legal framework, IT infrastructure, and change management, with tentative timelines against each of them. Challenges involved in the process of GST implementation were also highlighted, such as ratification of Constitutional Amendment Bill by 15 states within 30 days, presenting all legislative bills in the winter session of the Parliament and the state assemblies, constitution of GST Council within 60 days of enactment, establishing GST network and states IT back-end by November 2016, testing of software with live transactions by January 2017, outreach program as part of change management to be completed by March 2017. It needs to be mentioned here that VAT was introduced in all over country in 2006, and GST is the logical conclusion of the successful introduction and imposition of value-added tax in India. In its standard format, GST is a single tax replacing all the indirect taxes collected by a single authority. But in a country, the system of governance is federal, and both center and state have the power to collect indirect taxes in one form or the other. Hence, a formula is developed to introduce a compromised GST with the consent of states. Hence, we can call it Indian format of GST. The reference of GST was first made in Indian Budget of 2006 by Mr. P. Chidambaram, the then Union Finance Minister. as a single centralized indirect tax in which tax is to be collected by center and then it is to be distributed between center and states. This was the standard format of goods and service taxes. As we have mentioned, in a country, states have also the right to collect indirect taxes on sale of goods. Hence, the single centralized form of GST was rejected by the states at the initial stage itself. Hence, a compromise is made on dual GST. In this respect, in which both states and center will impose and collect tax on a single transaction and sale of service in the form of state goods and service taxes and central goods and service taxes. The Government of India is racing hard to get GST implemented by April 2017. Earlier, the model GST law was placed on public domain on June 14, 2016, providing an age to the trade and industry to prepare well in advance and scrutinize the likely impact of GST. GST is going to be a big game changer and will be one of the most significant tax reforms in the fiscal history of India to consolidate present multiple layers of indirect taxation and will have far-reaching impacts on almost all the realms of business operation in our country. It will impact tax structure, tax incidence, tax computation, supply chain optimization, credit utilization, compliance system, etc., leading to a complete overhaul of the current indirect tax system. It is noteworthy in this respect that certain amendments has been made to the model GST law placed in the public domain earlier. These are the proposed withdrawal of 1% additional tax to be levied by the manufacturer state in case of interstate transactions and the removal of 100% compensation to states for next 5 years to mitigate the loss they might face with the implementation of the GST. As for the impact of the GST, please look into the material provided along with this video. It is well illustrated there along with examples. Exemptions under GST. The bill excludes alcoholic liquor for human consumption from the purview of GST. Further, GST will apply to 5 petroleum products, that is petroleum crude, high-speed diesel, motor spirit, natural gas and aviation turbine fuel at a later date, to be decided by the GST Council. Petroleum products are inputs for several other goods and exempting them from the purview of GST could lead to a cascading of taxes. This is because the input tax credit would no longer be available on such products. This disruption in the tax credit chain would distort the GST structure and could lead to a leakage of revenues. The 13th Finance Commission and the Department of Revenue had recommended that all petroleum products and alcohol be brought under GST. The Commission had suggested that states would impose an additional levy on petroleum products and alcohol in addition to GST. Pros and cons of GST. Advantages of GST. GST will simplify the tax structure, broaden the tax base, and create a common market across states. Also, GST will lower the average tax burden for goods and services, as currently companies pay cascading taxes on top of taxes through the production process. The GST was initially intended to be revenue neutral, but is now expected to increase the tax take by following the unitary system for collection of indirect taxes levied on manufacture, sale and consumption of goods as well as services, thereby reducing burdensome compliance, high cost of transaction, and nagging uncertainty in tax liability for a business. By lowering business costs, it would boost economic growth and increase exports. This will help to bring India in line with practices in many developed economies. Reducing production costs would make exports more competitive. Disadvantages of GST. The main flaw of the bill is that it excludes important sectors such as petroleum, natural gas, real estate and alcohol from its ambit. Keeping sectors which are foundation of all commercial and industrial activity out would have serious implications for the industry, as their exclusion would result in considerable cascading of taxes. Exclusion of these sectors serves no social, economic or fiscal policy objectives. The second major flaw is that certain taxes such as the entry tax and octroi and the entertainment tax would be kept alive to the extent levied and collected by a panchayat or municipality. Thank you.